If you're scared about what's going on in the stock market right now, you're not alone. Portfolios are down, headlines are terrifying, and everything feels like it's about to crash. But here's what most people miss. This could be the biggest wealth building opportunity in a decade, if you know what to do. So in this video, we're going to be talking about how to build wealth in a market crash. You're going to be learning three things. First, we're going to be talking about what's actually happening in the stock market and in the greater economy, and why the market is reacting this way. Then we're going to be talking about what you can do right now to protect your money and stay on track with whatever your financial goals are. And third, we're going to talk about how to adopt this long-term mindset that helps investors come out wealthier and come out better on the other side. So why should you listen to me? Why Fiona? Couple of things. First, I help 453 millionaires build wealth. I became a millionaire myself at 27, literally practicing what I preach in these videos. I was a student at Harvard and MIT, and I also spent 11,000 hours studying, not to mention the 7 years actually in the field in wealth management. Now, before I jump in, make sure to like and comment on this video. I'd really appreciate it. So let's get started. And before I even jump in, I want to take a poll because I want to know where you are at, what you're thinking right now. Specifically, my point is, what is your biggest emotion when it comes to seeing the market crashing? Meaning, when you start seeing that red line going down, 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 and you see your portfolio going down too, which is not what everyone wants to see, right? So when you see these red numbers, are you panicking? Do you see it as an opportunity? Are you confused? Like, why is this happening? Or are you calm? I've got a plan. There's no right answer here, and there's no wrong answer. I'm curious for myself because I want to know what's going on, what you're thinking about. So with that, let's actually get into it. So why is this happening? Why is the market seeing so much volatility, so many ups and downs? Now, let's actually talk about why most crashes happen. This here is one of the core concepts and key reasons. Because they mostly happen when it comes to emotion. The reason why is because humans are known as what is called irrational. We are irrational investors, meaning we are not like Spock. Spock is a former character from I think 1980s, and Spock was very logical, used numbers to reason everything, did not use emotion. Spock was not necessarily human because everything came down to brass tacks and numbers. What is the cost-benefit analysis of this? If the cost-benefit analysis made sense, in other words, you made profit, Spock would do it. If you didn't make a profit, Spock would not do it. So that was Spock. Humans are not Spock. Even though we try to be sometimes, we're not. Why? Because we have this thing called emotion. And that's not necessarily a bad thing. It's what makes us human, right? It's what separates us from Spock and AI and robots in general. But sometimes emotion can hurt us, especially when it comes to making money in the stock market. Why? The three most common emotions are fear, because we're worried about losing money in the stock market; uncertainty, we don't really know what to do if the stock market is so volatile as it has been; and we also sometimes, let's be honest, have herd mentality. What that means is if your friend is doing something and investing in a certain stock or not investing, in other words, withdrawing money or selling in the stock market, then you might want to do it too. Because we're kind of programmed that way, right? We want to stick with the pack. We don't want to be that outsider, that oddball out, if you will. So herd mentality, it's to serve as a protection mechanism, at least back in the day. Nowadays, maybe not so helpful, at least when it comes to investing in the stock market. So these three emotions, they have hurt us quite a bit. I should also actually add greed in here. Greed is another emotion where we see what our neighbors are doing, like, oh my gosh, our neighbors just made $100,000 in cryptocurrency. If it's even true, you don't know that, but at least they say they made $100,000 in cryptocurrency. So you want to partake in that too. So you invest your money. And then ultimately, greed doesn't always serve us well either, especially in the stock market. And we end up losing money, at least for the most part. So with that, those are some of the common emotions when it comes to market crashes. Other causes for economic recessions are listed here. So demand supply imbalance. So think back to COVID. We had, for example, a shortage of chips, right? So semiconductor chips manufactured from Taiwan, the entire supply chain shut down, which caused a huge backlog in car manufacturers, right? So used cars actually became really expensive, as did new cars. They essentially were the same price. Computers, iPhones, etc. So there's that demand supply misbalance. You have inflation rates. Well, we just saw that in 2022, 23, when inflation went up to 9%. There was massive volatility. And even now, right, with inflation, to be fair, inflation is down, but there is also something called a tariff, which markets don't like because it is uncertainty. So that's also included. Interest rates. Well, if interest rates go down, typically markets actually soar, and the inverse also happens. If there's uncertainty, like if you don't really know what the Federal Reserve is going to do with interest rates, well, that also causes market volatility. Again, markets don't like uncertain or unknown factors. Sudden shocks, like COVID is a great example of a sudden shock, or even the great financial crisis of 2008. That was a shock, right? When people really started couldn't pay their mortgages anymore because of the variable interest rate in the mortgage. The interest rates actually went up, which meant their mortgage payments went up, their salaries didn't go up commensurately, and thus they actually lost out and they couldn't pay their houses anymore, their mortgage off. That was a pretty big shock to the market too. When the banks couldn't get the money from the mortgage payments, then the banks also went under. So it was really a shock initially, but also a domino effect due to poor allocation of resources, really. And then reduced confidence. So this is just based on humans, right? So human confidence. So if you and I are worried about what the stock market is going to do tomorrow, we probably won't be investing for two reasons. Either first, for fear, because we don't want to lose money, or second, we're not going to be investing today because it's at such a high point today, and tomorrow it's going to be on the bottom, and your goal is to get stocks on sale, right? So on sale, and that's why you would wait to invest at the bottom. So it's for two reasons. It's either for fear or for opportunity, and either way, you're going to wait and not invest today. So that's when we have reduced confidence. And then finally, fear of recession, right? If you're worried about the recession, these two kind of go together, I guess. If you're worried about a recession, same two reasons. You don't want to invest your money and lose it, or you don't want to invest your money today because you want to get the opportunity tomorrow to see stocks on sale. So these are some very common causes for recession, and I thought this really nicely summarized how recessions occur from an economist from the mid-1900s called John Maynard Keynes, very, very popular guy in economics, and he said the markets are moved by animal spirits and not by reason. So animal spirits, I also have a definition here, is the same thing. It essentially just means emotion. It's what people have. They're emotional beings, right? Like I said, we're not Spock, we're human. And so animal spirits here in a nutshell, it's essentially, it means the breath that awakens the human mind, literally translated. But it essentially means it's related to the psychological phenomena such as hysteria and mania. So if people are really worried, they have this herd mentality, they flock together, and then they pull the trigger, whether it's selling or buying more out of fear or out of greed, right? So it's gaiety means happiness, courage. So animal spirits as it relates to economics, it just shows how people arrive to financial decisions, whether to buy or sell, during periods of economic stress or uncertainty. So again, it's just people like in COVID, a lot of people are afraid, so they sell, or people are very greedy because the market keeps going up. They want a piece of the action, so they buy. So that's what animal spirits means. And again, like here you can see a couple of interesting charts, I think, where you can see how during certain recessions, so Black Monday, this was in just before 1988, you got the Asian crisis, the ruble devaluation, dot-com bubble. This is pretty recent, 25 years ago. You got the World Trade Center attack, 9/11. which didn't really contribute too much to the crisis. It was more the dot-com bubble and then the Lehman bankruptcy, aka the Great Financial Crisis of '08. But each time you could see how, people were not necessarily rational. They were worried about what was going on. And what does that mean? The markets went down. People started to sell instead of buy. If people bought more, then the markets probably would have stabilized a little bit more. You would want to buy because essentially it's an opportunity and stocks are on sale. So this is just another example, just a little bit more recent to 2023 because this chart up here ends in 2010. I think you have seen this quite a bit, greed, buy, but these are the two main emotions that rule humans, especially when it comes to making decisions in the stock market for buying or selling stocks. So it's really important to remember that the media plays a very big role in stirring the pot. How many times have you seen, whether it's online or whether it's on actual newspaper where it says the stock's about to crash and oh my gosh, markets are going to burst. This is the worst catastrophic event in a century. I hear it all the time. And yes, at some point, they are going to be right. They will be right at some point. We are going to have, at some point, a terrible crash. Likely, at least, right? Based on history. I'm just drawing this from history. But is it going to be today? Is it going to be next week or tomorrow? I don't know. No one really knows. If someone knew, just tell yourself this, if someone knew the answer to that, they would be the wealthiest person in the world. But that person doesn't unfortunately exist. You can only draw from as many indicators that you have available to you. So again, the media plays a very big role. Don't get too involved in that, right? So just understand that. It's clickbait. So again, the louder the panic, the more views they get. And in the end, it's all about views. There's something called if it bleeds, it leads, right? So it leads the newspaper. If it bleeds, if it hurts, if it looks bad, they're going to post it. Why? Because they get a lot of views. So same thing here. Like take a look at this chart. It's red, right? It's red. It looks bad. It looks painful. But again, it's just on a month-to-month basis. And this is very recent, as of April 2025. But now look at this chart. Same day. It's also April 2025, but it's green and it's happy. Why? Because it's zoomed out. So again, perspective matters, right? So I do want to list this out. Perspective matters. Matters a great deal. So just make sure before you're worried or before you panic, make sure you zoom out. Perspective really does make a difference. Okay, so history does repeat itself. What happens next? Every single market crash in history has one thing in common. Can you guys guess it? I'm going to let you guys kind of sit on this because it's really true. In history, every time after a market crash, what happens? Can you see a pattern? If there's a recession, so anything that's gray here is a recession, what happens? The market goes back up. If there's a recession here, what happens? The market goes back up. Again, recession, the market goes back up. Sure, it might not go back up to the same amount, to the same high point, to the same peak within a certain period of time, but it does rebound. Never, and I rarely say this, but never in the history of the markets has there been a recession and the markets just kept going down to zero and stayed at zero. It's never happened. Just zoom out and you'll see it has never happened, right? So a couple of things. After time, the market bounces back. The question is how much time? That is the variable. But after some amount of time, the market does bounce back based on history. And second, when it bounces back, it often rebounds higher. And we'll show you here in a second. Take a look at this chart. This here looks at the bull market, which is in blue, and then the red, which is a bear market. And then you have anything in these shaded peach color, I guess, is a recession. Very first thing I see here is that there's a lot more blue than there's red, right? You got a lot of blue here, which is a good thing because that means there's a lot more bull markets than there are recessions. So that's very good for you and me, the investor. The second thing you can see is, once again, my statement holds true. Never after a recession, like here in the Great Depression or here in the Great Financial Crisis, yeah, it went down really bad. It was negative, look at this, negative 83.4% at one point. But it bounced back. It bounced back. That's the point. Even here, negative 50.9%, but it bounced back. Again, the amount of time that it takes to bounce back, that's a variable, and you can see that in this graph here, where it shows depending on the length. So here you can see the number of months that it takes a market to rebound. That varies. So for example, you can see December 2007, so this is the great financial crisis, which did impact really the entire world. This was one of the longer recoveries. It took a longer amount of time. So based on this chart, we're looking at about 40 months here, right? 40 months it took for the great financial crisis to recover. Other crashes or recessions, like in 1957, this looks like it's the shortest one, was about 15 months. Now, think about COVID. COVID took only a few months for it to recover. It was kind of like a flash crash. COVID is so recent. Well, actually, they do have it, 11. Where's this? Here, 11. So it really didn't take too long. 15, so what is that, 17 months maybe? I thought it was much faster, at least based on the charts, but still, the point is it did recover very fast compared to other crashes like here, the great financial crisis. The point is that is the biggest variable, the amount of time to recovery. So in 2008, markets fell about 50%, but it delivered, after the great financial crisis, it delivered one of the strongest bull runs in history, climbing over 400% over the next decade. So over the next 10 years, from 2008 to 2018, the market recovered by about 400%, which is incredible. 2020, the market fell about 30% in March, in 1 month, if you remember that. That was a lot of panic and hysteria. But by the end of the year, you were back at all-time highs, right? So just think about how the time is the biggest variable. And the same thing here. This is a pretty interesting chart as well, which shows when the type of market correction, whether it was a bear market or a bull market. And I'm not going to go into too much detail here to save time, but just take a look here at the averages. So if you can see, the average bear market down was about negative 45%, and on average took about 25 months. Okay, so that's about 2 years. Now let's take a look at the bull market. On average, a bull market returned 152% and lasted about 54 years. So that's about, 4.5 years roughly? So that obviously tells me I would much rather want to be invested in the markets. And yeah, okay, I'll have to sacrifice a little bit here for 2 years roughly, but for that I get 4.5 years of bull runs. So that's worth it to me. And that's something that you need to also figure out, is that worth it to you? And the reason why we have this line here, for those of you who are not familiar yet, this 20% market decline, that means you have a recession on your hands, in part, right? There are a couple of other factors, but that certainly means that. Okay, moving on. We kind of talked about this. 2008, negative 50%, up 400. 2020, negative 30%, up 120 in 2 years already. And then 2001, this is the dot-com bubble, down 50% and up 100% in 5 years. So really one of the fastest recoveries was COVID, if you think about it in terms of time and amount in terms of recovery. So it really is the same story over and over again. If the market drops, that leads people to panic. But those who are staying the course, so those who are staying invested, they are the ones who are rewarded, right? So if you look at it, again, the zoom in, zoom out picture, in 5 years, the market looks like it's going to go up. That's the trend. But in 5 days, so this is the short-term version, it looks like there's massive volatility, right? There's so much volatility in the short term. So it's really important to zoom out. If it didn't feel like much at the time, like for example, if you're investing and you invest, let's say $100 a month, and you started investing, let's say 5 years ago, maybe in the short term, if you zoom in, it feels like it's just $100 a month. But if you zoom out, again, this is the benefit to zooming out, you can see that you've made such a large improvement, such a large investment over time. And that's something you need to keep in mind, especially during this volatility. Just remember to stay the course, whatever your goal is, whether it's dollar cost averaging or lump sum investing. So, and this year's the last napkin cartoon. I just love it. It's from this book called The Behavior Gap. A list of things helped by worry. There is literally nothing, right? So don't worry about the markets. You can't control what's going to go on in the markets. Just keep your course, stay investing. Crashes are not roadblocks. They are on ramps to the next bull market. That's how you have to think about crashes. So the next key concept I want to share with you is that time in the market is more important than timing the market. Time in the market is more important. It is the most important thing. Take a look. Missing the best 10 days of the market between 2001 and 2020 resulted in less than half of the total returns of staying invested. Now take a look here. This here is just based on the S&P 500. If you stayed invested throughout this entire time frame, 2001 to 2020, your return was about 7.5%, which isn't bad, right? It's expected. If you excluded the top 10 days because you were actively investing, you were in and out of the market, your return automatically fell to 3.4%. If you excluded the top 20 days, you're at 0% pretty much. And now, if you excluded the top 40 days, you're already negative 3.4%. This is shocking and really should help you really develop the evidence knowing that you need to stay in the market, time in the market, don't time the market. Timing the market, this here is just another way of showing you how much, if you invest $10,000 between 2003 and 2022, it could cost you so much money. Investment returns are 93% lower if the 60 best days are missed. Look at this, $4,200 versus $64,000 over the same time frame. It's pretty shocking if you're asking me. So if you want more evidence, here it is. Stay in the market. Extremely important. So here's just another image of why it's so important to stay invested. I think you can see now staying invested 7% versus a negative return. So I'm going to keep moving here. Invest early and often. This is absolutely the key message that I wanted you to take away. The earlier, the better. So what does all of this mean for you? Markets fall, but they rise more. Your greatest investing advantage is time, not timing. And I think I made that very clear with the evidence. So what do you actually end up doing right now? So right now you can do a couple of things. First, you can look at lump sum investing, and the second is dollar cost averaging. Lump sum investing is essentially where you you dump a bunch of money into the stock market at once. Dollar cost averaging says if you have, let's say, $10,000, you have a $10,000 lump sum, but you decide to divide it up and you do $100 a month in the stock market every month, and let's say into SPX, into the S&P 500. That's dollar cost averaging. Okay, so this is dollar cost averaging. It creates a dollar value and then it averages it into the stock market. Now, which one from a financial perspective is more valuable? Lump sum investing actually is more profitable if you just put your money into the market and make it work right away. Over a year time frame, you can see that lump sum investing typically gives you about 9% or 10% return versus dollar cost averaging gives you half of that roughly. And here's another chart that shows DCA versus lump sum. And you can see that at the end, lump sum averages out to 372 versus DCA is 342. So about $30,000 difference, right? So the question, now some of you might be wondering, why would you choose dollar cost averaging over lump sum? It smooths out volatility, it builds wealth, and also it takes the emotion out of the picture. And also it automates it. It automates everything. So you really don't have to think about it. Sure, with lump sum, you put it in, you never think about it again. But some people might have like buyer's remorse, if you will, like, oh my gosh, did I put in my money at the right time? Is the market going to fluctuate, go up and down? Dollar cost averaging just takes a small chunk of money and buys the market over time. And that's why I like dollar cost averaging, because I still feel like I'm taking advantage of the fluctuations of the market versus just choosing one point in time and dumping everything into the market. So that's why I prefer dollar cost averaging. The best, honestly, is if you do lump sum and dollar cost averaging at the same time. that's when you can put a lot of money into market corrections, for example, at once, while still continuing with your regular track, right? So continuing with that. So how do you actually stay financially strong now that so many things are going on in the market? First is to build a buffer, very important, which is just by starting with an emergency fund. If you don't have one yet, please build one up. The goal is to have about 3 to 6 months of emergency savings. And of course, with inflation now thankfully going down, but before, inflation does take a bite out of your savings, right? Every time during recessions, you can see how personal savings as a percentage of disposable personal income decreases or increases over time. So just make sure that you do try to save as much as possible. 53% of Americans do not have an emergency savings account. This is not good. Those who do have an emergency savings account, they're 2.3 times more likely to have $2,000 or more in liquid savings, which is great. 5.4 times more likely to have at least a week of cash on hand, and 2.5 times more likely to be confident in their long-term goals. And that leads to something called peace of mind. And my question to you is, can you put a price on that? I don't know. I don't know if you can put a price tag on peace of mind. So for me, saving that money in an emergency savings account is absolutely worth it. The second thing is cut non-essential things, non-essential spending. This is also known as discretionary spending, okay? So this is stuff that we don't necessarily need. Like housing, we need housing, okay? We probably need transportation. We probably need personal insurance and pensions. We probably need healthcare. We probably need food at home. But do we need food away from home? Probably not. Do we need entertainment? Probably not. What else? Apparel and services? Maybe. Education? Maybe. Alcoholic beverages? Probably not. Or tobacco? Maybe not. So there are a lot of discretionary items that you can cut down on in order to move into your emergency savings fund. Here's a cool chart, I thought, at least for average annual expenditures. You can see how much people typically spend on housing, transportation, etc. as a share of their income, of their annual income. And you can see, like for example, this entertainment is almost 5% of their annual income, or food away from home, that's over 5%. These two items alone is about 10% of your annual income, and certainly could be a great way to save more if you decide to cut these entirely, at least for however long you need to build up and replenish your emergency savings account. So what can you trim? Things at least that come to my mind is Netflix, or let's say you really like Netflix, because I like Netflix too, to be honest, but other types of subscription services. For example, if you have Netflix and HBO and a couple of other things, maybe delete the others and just keep one, or other subscriptions. Uber Eats, you don't need it. Eating out, probably don't need it if you really are committed to building your emergency savings fund. So always look at things that you can trim, at least for the short term, right? You can always add them back into your budget in the long run. But short term, try to be very Spartan with your spending if your goal is to build your emergency savings fund. Next is stay in the market. Downturns really don't last forever, and they offer a once-in-a-decade buying opportunity. And so this chart, if anything, is actually kind of a cool way to look at this, because you can look at returns over various time horizons from the S&P 500. So if you take a look, let's say at 1993, and you want to see what's the 9-year return after 1993, you look at the number 9, so number of years forward, right? And then you can see here in 1993, if you were invested in the stock market in 1993, the stock market returned 14% up. What's interesting is take a look at these red boxes here. The stock market only returned negative up until a decade later. That was the longest period of time where it had a negative return in the number of years forward. So 10 years after 1999, 10 years after the dot-com bubble, the stock market was up or actually down -1%. Here it was 0%. So what was that? 5 years after the great financial crisis, it was literally at break even. It was at zero. That's how you read the chart. So really interesting chart. And again, for the most part, I see a lot more green than red, which tells me it's much better to be invested than not invested or afraid. So when the market drops 20%, your 5-year forward returns are positive for the most part. And then it's very important to keep this long-term mindset. Again, this chart shows how important it is to have that long-term mindset. So before I close it out, I'm actually very curious, what is your plan right now in the stock market? Are you planning to keep investing or hold your cash? Did you panic sell when you saw the volatility? Which is okay. Again, there's no right or wrong answer. I'm just curious. And then are you still figuring it out? Which is certainly okay too and might explain why you're watching this video. The most important thing is to really start building your wealth right now. So if you found this video helpful, please like and share to help others. And make sure to subscribe to my YouTube channel. It's _MMW for more cool insights. And then definitely join my newsletter for more exclusive tips. And the link is in the description below. Thank you so much. Bye-bye.